On today's podcast, we're going to talking through really what the IRS requires as it relates to S corporation payroll. Now, there are a lot of clients that come to us, or maybe in conversations with clients, we'll be talking about whether or not to make an S corp election for their business. And I know there's a lot of information out there. If you've ever gone through and maybe gone to a seminar or maybe had a tax strategy session, this is kind of one of the areas that's talked about the most. And that is whether or not you should make an S corp election for your LLC or for your corporation. And it's usually most of the time it comes from a direction of trying to lower taxes for the business owner. Let me walk through that just a little bit and kind of what that looks like and what the thought is behind it, and then we'll unpack it just a little bit. So, say for example, you have a company, and say it nets $100,000 during the course of the year. Now, if you're a single member LLC, for example, it will go on a tax as a disregarded entity. It will go on a Schedule C on an individual tax return, and you'll pay a couple different types of taxes on that $100,000. You'll pay self-employment tax, which is essentially 15.3%. It's called SECA tax, or self-employment tax, which is comprised of the Social Security and the Medicare portion. And then you'll also pay your ordinary income tax. So wherever you're falling in the tax brackets, that is essentially what you'll end up paying on that income. So the thought behind it is, if you make an S corp election, you can go ahead and you can set your salary, say, at $60,000. And you'll pay your payroll taxes, which instead of SECA tax, you pay FICA tax, which is the same 15.3%. And then your ordinary income tax you'll pay on the full $100,000. And where the tax savings comes into play is essentially the difference between the $100,000 and the $60,000, paying the FICA or the SECA tax on that $40,000. Of course, you'll pay some unemployment tax and whatnot as well, which is minimal. But essentially, you'll end up saving usually somewhere right around 10 to 12% on the difference between the net income and your salary number. Now, the problem is that with this, beyond just whether or not this is the best tax strategy for the client, because many times this conversation is very siloed and based on some basic assumptions, is that very few businesses actually follow the guidelines of what the IRS requires. So what we end up saying is, on one end, the company simply just does not have a process. So either the owner is not taking payroll at all out of the company, okay, or they are simply just continue to operate that LLC checkbook or that company checkbook as if it's a sole proprietor. So they don't have a process in place as far as making a determination on distributions and making sure that you're following what the IRS requires. So that being said, let's kind of walk through a little bit as far as what the IRS does look at when it comes to determining whether or not the owner of an S corporation is taking a reasonable salary from his or her company. Now, the IRS does require that an S corporation owner take a salary from the business if they do anything beyond just contributing capital. So if you're an owner of an S corp and all you do is contribute capital, you have no role in the operations of the company at all. You're completely hands off. You're not going to meetings. You're not involved at all. You just simply contribute money, and that's it. Then in that case, there you would not need to take a salary from the S corp. Now, that is very, very rare. Usually with S corporation, that owner is involved in some form or fashion, and most of the time with S corporation or entities taxed as S corporations, those shareholders are actively involved in the business. So it may not be what they do full time. Most of the time it is, but they may have some role. It may be one of a number of companies that they own, and they may be working on the business 10, 20, 30 hours a week, or as in the case with many S corp owners, that the actual owner is actually running the day-to-day or involved in the day-to-day of the business. Now, you need to kind of run through or understand at least a little bit of what the IRS does require as it relates to what sort of payroll should you take out of the business. Because many times what we end up seeing is, at least either in conversation or in application, when a client comes, when we end up onboarding a client, is they say, well, you know what, I'll set my salary at $24,000 a year, and I'll pay the payroll taxes on the $24,000, and I'll just take the other, $60,000, $70,000 out of the business and distributions. Okay, there's a couple problems there, but the biggest problem is that in all probability, if your company is making $100,000, you probably whatever input or work that you're putting into the business is probably worth more than $24,000. So you really need to make sure that your salary is set in a way that is consistent and compliant with what the IRS does look at and what they do require. So the IRS does recommend that you consider the following as it relates to setting your owner's salary inside of your business. First of all, take a look at the duties that you're performing. So taking understand what exactly is it that I'm doing in my business. So if it's kind of one of those things that you have an S corp and you're just simply going in maybe 5 hours a week and you're just providing some advisory services, that's going to look a lot different than if you are running the day-to-day operations of a multi-million-dollar corporation. Okay, so what are the duties that you're actually performing? Are you just going in and just doing a few hours of admin task every week, or are you actually running this company and you're involved in the day-to-day? You're making decisions in the day-to-day. So what are the duties that you're performing? Secondly, the character and the amount of the responsibility. So not just are you performing duties in the company, but what exactly is it that you're doing? Next, the complexities of the business. So the type of business that you are running. Now, if you're running an engineering firm, for example, that is a lot more complex of a business than, say, maybe running some sort of an online retail shop. Not that is, one is, I'm not making any sort of an evaluation on the quality of one business or the other, or the quality of the business owners. It's just bottom line. Running an engineering firm, for example, is going to be a lot more complex than running an online resale shop. Okay, so how complex is the business? What is the structure inside the business? And so kind of taking a look at this, what sort of level of knowledge does a business owner have to have in order to operate that business? So what the complexities of the business, the amount of time required. So what is the amount of time that you're actually spending in the business, and what's the amount of time that's required for you to fulfill your duties inside of the business? Next, the cost of living in the locality. So we're kind of moving outside of just inside of the business itself, but taking a look at what are the payroll numbers in that area? What is the cost to live in that area? So my office sits in Northwest Indiana, just outside of Chicago. Now, if you were to take my office, and I'm in a small town in Northwest Indiana, one of the nicer towns in the state of Indiana, but bottom line, it is not as expensive, and I don't need to pay as much for an employee that's here in this area. Even though the county I live in is right next to Cook County, Illinois, where Chicago is at, the cost of living isn't quite as high here as it is in Chicago, for example. Okay, now take this same business and move it to New York City or move it to Los Angeles, California, then the cost of living is going to be even higher. So the cost of living does come into play. Where's your business located? So that is going to have a role as far as on the determination of the payroll amount. Next, the ability and achievements of the individual performing the duties. And so what is your skill set? Taking a look at your education background. So, for example, I own or partially own a few businesses, but my accounting firm is my primary business. Well, guess what? Most people in society cannot do what I do. Okay, and it doesn't mean that I'm smarter than they are, whatever the case may be. It just happens to be that I have licenses that allows me to do what I do. Same thing, I have team members. They don't have the same licenses that I have, and they can't do what I do. Okay, so what are the abilities, the skill set that I have, the licenses that I have, the education that kind of went into this, the undergrad and advanced degrees and whatnot that came into play in order for me to be able to have the ability to do what I do, and also to get the licenses that I hold. That's going to hold a lot greater value than a business that's being operated by someone or a type of business that doesn't require as much of a skill set or as much education, et cetera, to operate it. Okay, so that is just one of the number of factors, but the abilities, the achievement, the skill set of the owner, and what is required to run that business. Next, pay compared with the gross and net income of the business. So for example, if you're operating a business that's if you're operating a $10 million business, that is going to require a higher salary amount than if you're running a smaller six-figure operation. Okay, so it's going to evaluate, taking a look at the gross amount of revenue of the business and also the net income of the business. Okay, so these factors will come into play. Next, the distribution to shareholders, and this I think is kind of the one area where people really get hung up. And if you're a business owner and say, okay, I'm going to set my salary at $1,000 a month, and I'm going to take $1,000 a month in distributions. I've heard this over and over and over again. The IRS, if they come in and audit, will reclassify that recurring $1,000 as salary. Okay, if you're going to take if you need $2,000 a month which I think is probably extremely low unless you're kind of not involved in the business, it's a really small business. But say for example, your business essentially, we're taking a look at it and you're saying, okay, well you need to live on $80,000 and you're going to take an $80,000 salary, but you say, okay, no, instead I'm going to take 40 and 40. And so I'm going to set my salary at $40,000 a year, and then I'm going to take a few $1,000s out a month in distributions, and I'm going to do this regularly. I'm going to set this on autopilot. Okay, no, you need to set your salary at $80,000. So the distribution, that process. Let me kind of walk through what that process should look like. So ideally, those distributions should not be getting made monthly. They shouldn't be kind of one of these things. Okay, I'm going to take a look at monthly, and I'm going to say, okay, this is what I'm going to take in distributions. I would say at most that, and this is practical. This isn't like written down. This is an IRS code, whatever the case may be. I'm going to come more from a little bit of a practical direction here. One of those things where you actually have a board meeting. Okay, you actually sit down and you have a meeting quarterly, and say you're the owner of the company. You bring your leadership team, whatever the case is. You come in, you have the meeting, you're analyzing your financials, you take a look back at the previous quarter, and you say, okay, our company netted $30,000 last quarter. We are going to declare a distribution, or if you're an actual corporation, then we are going to declare a dividend distribution of 22% of the net income or a set amount, whatever the case may be. So, and there's actually a process of taking a look back at the numbers and making a determination of this is how much money we need to leave into the company, and this is how much me as an owner I'm going to take out. This is above and beyond as you're setting your reasonable salary requirement. So your distribution should not be part of your calculation of what you need to take out of your business to operate your personal life. Sometimes I'll advise clients and simply state, okay, what does it take to operate your life beyond just looking at what are the actual salary requirements. So say you're operating in a business and your skill set, everything only requires a salary of $60,000, but you need $70,000 a year to live on. Instead of taking the $60,000 and then just taking $800 a month or whatever the case may be in regular distributions, go ahead and set your salary at $70,000 or $75,000. That way you're not tempted to go in and violate some of these rules, that your salary is already set in a way that it's going to help to cover your lifestyle. So that's not one of the IRS, one of the areas that they say to look at. But I think practically you should set your salary in a way that you're not tempted to go through and fall outside of really what is required as far as making a declaration as far as a distribution from accumulated earnings and profits or retained earnings of the company. So a distribution to shareholders. Next, a history of salaries paid to other employees. So I've been doing this long enough. It took me a while to kind of figure out, okay, what should I pay people, that type of thing. But if your business has been around for a while, you kind of know what you generally pay people when you bring them in. So if you normally bring a team member on and you're paying them, say $45,000 is kind of your baseline starting pay, but you decide to set your salary as the owner at $36,000, okay, that's going to be an issue. Okay, so you as the owner, generally speaking, you're going to have the highest salary of anybody in the business, and so the IRS can go in and take a look at what is the history and salaries paid to other employees, and what are your company policies regarding wages, even getting into bonuses and benefits and all these types of things. So is what you're doing inside of the business, is it truly comparable to the work that you're performing, to wages paid in your area, to everything that you're actually doing inside of the business, and also taking into consideration the revenue of the company, the complexities of running the business. So kind of the takeaway. If you own an entity taxed as an S Corp, so say it's an S Corporation, an LLC taxed as an S Corporation, make sure that you sit down and you're evaluating, is your salary that you're taking out of the business, are you compliant with what the IRS requires? And are you paying yourself a reasonable salary? If you had to go outside your business and hire someone to sit in your seat, what would you pay them? Okay, if you're running a $500,000 gross income business, you're not going to go out and hire someone to run the day-to-day operations of your business for $36,000. You're going to have to pay them relatively well to bring them in to run your business. So paying yourself $36,000 is not going to be a reasonable salary. Okay, so take a look at some of these factors and sit down and analyze. And this really should probably be done annually. Set your salary up in a way that you're not setting yourself up to fail. But you're not going to go in and say, okay, I'm going to pay myself a low salary to try to save in taxes. There are plenty of other tax strategies that can be used that are practical to lower your tax exposure. This should not be your lead in to how you're going to save in taxes. If you're talking to an accountant and you say, okay, this is going to be your best strategy without having this broader conversation, some of the things that we're talking about here, then you may want to consider who you're working with. Okay, so really the conversation should be broader than just simply, okay, you're going to pay yourself as low as a salary as possible, take the rest of it in distributions, just simply to try to lower your tax exposure. That is not that really shouldn't be the lead into why you make an S Corp election or operate as an S Corp election. It's just one of a number of factors that you'll want to take into consideration. Hopefully this particular podcast brought you some value and was a help. I understand this podcast isn't for everyone, but I think for many clients that may hear, or many individuals that are operating a business, that when they hear this nugget in a room that they're in, or maybe even from someone who's very well-meaning or an advisor, they say, well, just simply make this S Corp election. Make sure that you understand everything that's involved in that process, especially as it relates to how you pay yourself in your business. My name is Josh Belk. This is the Belk on Business podcast. Thank you for listening in. Have a wonderful day.